Okay, we are going to get started. First, I want to thank everyone for being here. We're super excited about our latest educational program, the Left Field Investors Lunch and Learn. And we are hoping to do these on a monthly basis going forward. And they will be at lunchtime in somebody's time zone. I realize if you're on the West Coast, this is breakfast. But we're on the East Coast time zone at least. And so this is lunch for us. And so we're calling it a lunch and learn. And as I said, we're going to do these once a month. And if people are interested, we could even do them more. What we're trying to do is give you content about asset classes, investing strategies, tax strategies, all the stuff that we're talking about in our monthly meetings and in the infielder forum and mound visits and intros and all the other educational things we do. We're going to make this a new way to learn about different asset classes. So I'm not going to give huge introductions here, but I will say that I was introduced to Christopher Nelson through an infielder, which, as you all know, we talk a lot about how you're introduced to somebody by someone you know, like, and trust, who's already done business with them. And that's kind of how we met Christopher. I'm meeting Bo for the first time here, but Christopher is the founder of Wealthward Capital, and Bo is active duty soldier in the U.S. Army, retiring this year or already retired. So thank you for your service. He is also managing partner of Fortify Capital Group. They are here today to talk about the why and the how of investing in mobile home parks. And I know they'll give you a better introduction to themselves than I just did. So I'm going to pass it over to you guys. And you guys tell us how you want to do it for questions. Either we can put them in the chat as we go. We can have people raise their hands as we go, or we can hold them all to the end. You guys are in charge of that. So I'm going to turn it over to you.
Excellent. Well, thank you so much, Jim. And I think, our preferred cadence is, I don't know if, is that Jerry's iPhone? There we go.
I think everybody is, there. Sorry. Yep. I'll mute that.
Thank you, sir.
Yep. Now you're good to go. Sorry about that.
Right. So what we will do is we have in this presentation, we're trying to answer 3 big questions for everyone. And so what we'll do is at the end of every section where we answer a big question, we'll pause, we'll take some questions for a few minutes, and then we'll keep it moving. Okay? That's what we'll do. All right. So let's dig into it. And can Bo give me the thumbs up? You see the right screen, Bo and Jim? Yep. Okay. You see it. So we're here today to talk about why mobile home parks and how to invest. And so before we get into the theme of mobile home parks, we will just go a little bit more into who we are. My name is Christopher Nelson. I think the important thing to know about me is that I got into and started Wealthward Capital because I was a passive investor coming out of the technology space, been through a couple IPOs, wanted to deploy capital. And as I started investing passively and I started, learning and studying and investing here in Central Texas and multifamily and discovering other asset classes, I had a lot of other technology employees that were asking me, how do we do this? Please help us. And so Wealthward Capital was built in 2017 to help other technology employees. And we structure it as we are the lead investor. Our goal is to be investing our family's capital and have other people participate with us. So we are different. And you'll hear as I go through this presentation, I look through everything as the lens of the limited partner as an investor. And how is this going to affect my portfolio? And you'll find that that really influences how Bo and I also do business together, because we're very, very investor focused. But that's a little bit about me. Now over to Bo.
Hey, Jim, I appreciate you guys having us. Time to talk to you guys. Looking forward to it. I am Bo Wiltshire, founder with my wife of Fortify Capital Group. We're getting ready to retire probably next week. So you're welcome for your thank you. And then, been at that for 20 years, 9 combat deployments. Been serving in a special operations unit here at Fort Bragg, North Carolina since 2007. So my beat up, tired body is tired and ready to transition to something else. A couple of years ago, we started looking at what we wanted to do, did some vivid vision stuff, and decided we're going to go, full throttle into real estate. Started looking at multifamily and ended up, on the mobile home park space, and I've learned a lot in the last few years about that. So really excited to be here with you guys. As Christopher said, fire some questions off at us. We'll make this as interactive as you guys want to be.
Yes, we will. So our goal today is we want to answer three main questions, because we believe that as investors, as you're looking at this asset class, these are the questions that you're asking yourself when you're thinking about mobile home parks. Is we hear a lot about this asset class, and you may not have heard, but mobile home parks are touted as very recession resistant. This is where you want to be deploying capital when you start seeing headwinds in the economy. That doesn't mean you don't want to deploy capital when things are going well, but this is what you hear a lot about this asset class. And so we want to answer this question: is, are mobile home parks truly recession resistant? And what is the data behind that? The other thing is you may have heard, and if you haven't, mobile home parks give off tremendous cash flow. And so then we also want to walk you through, when you're thinking through this asset class, the way that they operate, the way they function, the mechanics behind them. Why and how do mobile home parks produce such great cash flow? And then also we'll touch on just a little bit, are there buying opportunities today? But more than anything, we want to then get down to the bottom and really talk about what are the ways that you can invest. What are things that Bo and I have learned along our journey, and hopefully that we can share something that is valuable to yourselves. So before we even get into any of that, let's just start and give a little bit of an overview on mobile home parks themselves. So it's important to understand that, many people, talk to mobile homes, but there is a distinction between a mobile home and a manufactured home. So the reality is that there still are a lot of mobile homes out there. Mobile homes were truly, manufactured in the 60s and the 70s, have great steel frames, have great bones, and you're able to rehab those very well with lightweight materials. But it's actually post that then they started the era of the manufactured home. And the manufactured home has a lot more requirements, falls under, specific HUD codes, housing and urban development. And, again, these homes also, it's important to understand, come in three sizes. You hear a lot about single wide, then there's double wide, and then you can also have triple wide as well. And you'll find that most parks today are mixed. You usually have some mobile homes in there. You have some manufactured homes. We tend to call our parks mobile homes because we tend to have the majority of mobile homes in there. The other thing that's important to understand is that the rating of mobile home parks is different from apartment buildings and other asset classes. They're graded in 1 to 5 star. So a 5-star park, if you can imagine, is going to be on the coast of Florida near a golf course, and it's going to have many pads in it, and it is going to have homes on it that probably are going to retail for $80,000 to $100,000, and it's going to have very high lot rent, manicured golf carts, beautiful. On the other end of the spectrum, there's a 1-star park where you're going to go in there, and you and I probably would not feel safe walking in that park. Like there's a lot of stuff going on that you don't really want to know about. And so it's important to understand that there is that full spectrum of mobile home parks. And so, and then also understanding when you're starting to get data and you hear data, people are talking about mobile home parks, they're talking about, cap rate, compression. What class of park is that? That's an important question as an investor, because the view from the market is that not all of these asset classes are appreciating as fast as others. 1-stars are definitely not getting the cap rate compression that you're seeing on the 5-star parks. Is there anything that I left out on that, Bo?
No, I think you nailed it.
All right, well then let me turn it over to you, and let's talk a little bit about the real estate mechanics of a mobile home park.
Yeah, so if you're a little bit familiar with how mobile home parks work, you'll start to see different terms that fly around with lot rents and home rents, and what does that mean? What do you provide? Like if you sign up to be a mobile home park owner, what are you doing? So the gist of it is the park owner provides the pad, the lot, the site, a lot of different. It's not very clear across this niche of what verbiage means. So essentially, whatever you call it, your lot, your pad, your site, you provide utilities for somebody to park their home, or you park your home, which is a separate asset, on that spot. You have sewer, you have water, you have electricity, and everything else is really negotiable. So you don't see a lot of the amenities that you normally see with multifamily, where there's not typically like a cable deal, and there's not typically, sub-metered electric or that kind of thing. But you can find that in some places. But as the park owner, you are responsible providing those services to that pad, whether you own the home or the resident owns the home. So the administrative services is another big one. A lot of times municipalities will talk to you about, taxes got behind. Can you lean on Mr. or Miss So-and-so to help us get this sorted out? Since it's parked on your lot, and if we end up having to put a lien against it, you're probably going to have to buy it. So you provide all of those things as well. The big thing and the real distinction and kind of the jackpot of this whole industry is the tenant owns the home. And that's ultimately the goal where you want to get to as far as ease of operations. And for that, your expense line comes way down because they own most of the problem parts of the real estate. The home repairs, the maintenance, the leaky roofs, leaky toilets, my floor has got a thing, my doorknob fell off, all of that stuff that makes people hate being a landlord, the tenant owns that. And as long as you can provide services to that pad, your job is done, and that is their problem. So if you're familiar with other asset classes, if you've got a 45 or a 50% expense ratio for a multifamily, here you're looking at like 30 to 35% is a well-run park, and that's a win. And that's a huge bump to the bottom line. And that's really the mechanics, the leverage that makes mobile home parks such a compelling asset class.
And so that's the fundamentals. So now you understand a little bit mobile home, manufactured housing, both sort of teased out. You have lot rent, and then in park owned homes, you also have home rent. But again, the goal is we're trying to get to the point where you have a lot of tenant owned homes. And then you think about it, the mobile home park owner is really a glorified HOA, really doing the landscaping, providing the services, etc. And so we wanted to make sure that you understand that's really the fundamentals of mobile home parks, manufactured housing parks. And the key thing, again, understanding there's lot rent and then there's home rent. So those are some key things to understand as we move forward. What we want to talk about now, and this is going to get into our first question, is we want to talk about the state of the market. Let's look at this asset class from the top down and understand a little bit of supply and demand in the space, because this is really going to help answer the question, are mobile home parks really recession resistant? And so I think that right now, the important thing to understand is that we're in an affordable housing crisis, right? We may not be personally, right? There may be, in us living in the world of accredited investors, we are not feeling that crunch, but there is a lot of pressure. You're seeing right now a lot of rent increases, a lot of apartment buildings and rents increasing, and you have families that are, 2, 3, 4, 5 people that are really finding it hard to cram and afford into a 1-bedroom apartment, and so this is where, if you look at it, mobile homes really fit the bill, because you can get a single wide that can have 2 or 3 bedrooms, fit your family. It has a nice yard, has some space, right? You're finding that it is going to be half, generally speaking, the lot rent of a mobile home park, lot rent, you got that now, is going to be half of what it is to live in a 1-bedroom, let's say B-C apartment building in that area. It's important to understand that this is something that is for the bottom tier of earners. And this is also something that, 10 million households here in the United States, face this. And this is something that's growing every day. Why don't you give us a little insight into some of the baby boomer tailwinds, Bo?
Yeah. So the other big push on that, aside from the macro, state of the country with that many people looking at it, one of the things that's really starting to increase that demand is the baby boomers. They're retiring, 10,000 turns 65 a day. A lot of them don't have a lot of stuff, a lot of savings built up. They're definitely on the other end of the spectrum. They're on a fixed income, or they're not, and they just had a 4 or 5 bedroom house that, that was their largest asset. They sold it. Now that's their nest egg, and they need something more affordable, so that, when they started saving, they were going to live to 60, and then everybody was going to head out. now people are living to 85, 90. You got to stretch that out. They don't need a 3,000 square foot house. We've got people that are moving in. You know, the guy just bought the house right behind the office here. You know, he sold a 4-bedroom house. His kids moved out, and, you know, he just needs a 2-bedroom mobile home that, you know, costs him $800 a month, and he's happy as a clam. So, you get a lot of these people coming in that are looking for, how can I take my nest egg and stretch it out for the next 30 years? So we see a lot of those people coming in. They are competing very well with the low income people that are much younger, starting families. We didn't really touch on it. I don't even think we have a slide for it, but Christopher and I have discussed it. With rates going up, everybody else is looking like this could be, you know, a horrible, horrible thing. For us, I've seen more demand from extremely qualified applicants in the last few weeks, where people are, you know, they had money set aside for their house, their starter home. They had put $20,000 aside and they were going to buy a home. Well, now that might be out of their price range, you know, once rates go up 2 points. So that pushes a lot of people our direction that are extremely qualified, medical personnel, teachers. We've got 2 universities here in Fayetteville. It pushes a lot of their staff this way, just because it's great locations. You're right in the middle of in the town, and you've got a lot of people coming in. They're like, I don't know what the market's doing, but I'm gonna, you know, buy a home here. I don't want to live in an apartment, and we're welcoming them into our community. So baby boomers, a lot of people that got ate up with the increasing rates, and then just the overall state of low income in this country. Huge market shifts happening right now.
Yeah, and it's only going to grow, right? I think right now, I think they said in 2020, 1.7 million baby boomers retired, and they're imagining that is going to then increase to another 10 million for the next 5 years. You know, they're coming out of the job market, and we're seeing what Bo is saying as well. So when you take these forces, right, and you think about raw supply, we already have, you know, people that are getting priced out of the housing market. We have the baby boomers. And then if you add in a recession, any type of downward pressure where people are losing jobs, or you have that cascading effect where people are in Class A apartments, go to Class B, go to Class C. Class C is pushed out. You have workforce housing. What are they looking for? Mobile home parks. So you have this ever increasing demand. And I'm sure Bo can tell you, you know, as we go and we put homes on the market, the amount of inbound that we get is just out of this world. So we want to make sure that you have data, you know, that this tops down data that we're gathering from larger sources, but we also want to make sure that we're providing you, like, you know, word on the street, people in the parks, that this demand is real and it's there. And so I think the challenge, you know what I mean? And I'm going to have Bo speak to this, and then I can speak to the next one. But the challenge that we're having then is limited supply. So this is where you have this overwhelming demand that's coming in, but there is a very limited supply. And I know that Bo has seen, you know, on the streets there where we're operating now in Fayetteville, you know, some real use cases of what's happening here. So why don't you walk them through the challenges, Bo?
Yeah, so probably the question that's going through your head is like, if this is such a great deal for everybody, why aren't there more of them? Why aren't we building mobile home parks? And you see the challenges right there in front of you. So not in my backyard. While everybody wants to be part of the problem, it's really awesome until, you know, somebody's going to develop a manufactured housing community right over your property line. And then the zoning committee gets involved, and you have town meetings. Nobody wants that. So they are actually tearing down about 100 mobile homes per year and building about 10 across the country. So very limited supply there. It's a dwindling supply. It is constrained. So it's almost like a monopoly where you just can't have any more competition, where, you know, self-storage, multifamily, like you can own a building, they'll build a building next door. You can own a, you know, self-storage facility, they can build one the next block up. That is not the case with this asset class, and that is a huge win for us. From the municipal point of view, you've got extremely dense, low-income housing with a lot of kids, very, very, very low property tax rates. So from their point of view, they're shelling out a lot of resources for not a lot of property tax return. So there's not a lot of return on the investment. So while they are not outright aggressively against you in a lot of cases, sometimes they are, but they're not really, you know, pushing you to get more in there either. So again, back to the NIMBY thing. So building backlog, once everything kicked off with COVID and everybody's supply chains backed up, mobile homes are about 9 months behind. So if you put in an order right now to get a new mobile home, it will take you 8 to 9 months right now, unless you bought one off a retail lot, and the prices have gone up about 30% in the last 18 months. So what used to be a, $30,000 or $40,000 mobile home, if you can get one now, it's a lot more expensive. The credit's tightening up for them as well. So you end up with those. Those are the three big challenges that really drive limited supply for us and give us an edge in this market. So, and Christopher alluded to it earlier, the ones that are tearing down about, a mile and a half from me right now is a 100-space park. It's got 100 homes in it. Most of them are empty because a multifamily developer has bought the land behind it and has paid $3 million for the park and just tearing it down so that his development doesn't have to look at the mobile home park. So, unfortunate for them. I think it's going to work out in our best interest because we're going to buy a bunch of very available homes here shortly and fill up our parks. But it's a real sad thing for the residents that have lived there, some of them for 10, 15 years, and now they're going to have to move, to make way for a larger development. So a lot of challenges for this asset class.
Yeah, and we just wanted to give you just this screenshot from Green Street Advisors, where it's showing you that right now you can see that there's a huge manufactured housing shortage, right? So this is the 95 to 09, still not a lot of building. 2021 maybe ticking up a little bit, but there's not a lot of plan to build much more. So I know we're about 20 minutes in. I want to know, do we have any questions? That's sort of our first question, and that really answers the question of, are they recession resistant? Yes, because you have this outsized demand and you have this shrinking supply. And so this is why, getting a hold of a mobile home asset right now, operating it well and positioning it for a long-term hold and cash flow is a phenomenal strategy, because they're not making any more right now, or they're not making them as fast. You can see, is definitely a lot lower. But if I don't see any questions, why don't I, with this in mind, Jim, I'm just going to keep plowing through and we're going to answer the other question is, how do they stack up? So, okay, so you have this, this great demand, this low supply, but how do you get this cash flow? How do these parks actually work? So we're going to go back to some of the things we covered earlier and talk a little bit about this, right? Is the advantages of mobile home parks, right? Is it is a low point of entry, right? And it is this, this affordability that attracts residents to the mobile home parks. And again, if you have a nice, well-run park that looks nice, that has a lot of physical safety, that is going to then, attract a lot of people. Once people come in, and again, operating on this model of moving people from, the park-owned home to the tenant-owned home, once they own their home, they've lowered their whole cost of living because they're just really focused on the lot rent. Then you're going to find that you have much lower turnover. They own their home. They're not going to want to move that home. They're going to want to stay there. The other thing that I think, Bo called out is the low operating expenses. Again, moving it to a tenant-owned home model. And even before that, right, a well-run mobile home park, you can operate in a 35% expense to income ratio, which is a lot lower than a multifamily. Why don't you touch on the accelerated depreciation and the reduced maintenance?
Yeah, I just saw from Mary, she asked about the depreciation. Depreciation is actually really good. It's comparable to what you would find in multifamily as far as ratios go. The big thing about mobile home parks are the cost to get in is so much lower that the cost of running utilities, signage, landscaping, the things that you can normally accelerate your depreciation on, take a much bigger chunk out of it. The land is, negligible, not as low a ratio as you would find in typical multifamily, but it's low, and you're going to get plenty of depreciation out of this. Jumping back over to the slide real quick, the affordability thing. A cheap apartment here in Fayetteville for a rough area, $800 to $900 a month for a 2-bedroom. Our lot rents are half that, and for us that's a huge win. Because of that, I see one more question from Scott about transitioning to tenant-owned homes. We have low turnover. The interest rate environment doesn't really affect it because we own the homes, and I don't charge them any interest. So we don't have to. For us, the money's not in the home, the money's in the lot. And that's the way the bank looks at it. So we play their game. So very low turnover. We get sticky tenants out of that. If I can get you a chance to spend, a few $1,000s over the next 5 years to buy your home and pay us a really, solid lot rent, it's a win for both of us. Now you can control the cost of your rental expenses for the next few years. And we get to, go back to the bank and say, we have a lease with a doubled lot rent. Low operating expenses. We talk 30 to 35%. Sometimes we'll tick that up to about 37 to 38 for our underwriting, just to be conservative. In reality, sub 35 or sub 30% expense ratios are not uncommon, especially once you got everything stabilized and over to tenant owned home models, and everything's just kind of humming along, and your management system's in place. We'll run 28% all day long and never have an issue with that. The accelerated depreciation, we just got a cost seg back for a couple parks here in Fayetteville. Really, really good numbers. I don't want to talk about them here just because we're waiting on K1s to fly out to all of our investors. But they're good, and everybody's really happy about that. The reduced maintenance. Once you kind of got everything, you're a parking lot with utilities. It's pretty good. There's not a whole lot going on as long as you don't have residents driving extremely heavy work trucks over water lines, sewer lines, septic tanks, things like that. There's not a lot to it. Yeah, so those are really good asset classes. Why? I see one question over here of about converting to multifamily. The IRRs can be the same. They can be better. They can be worse. It really depends on the area and what the demand is there. For Mr. Rowe, any definitions for a 5-star park rating? No. And that is one of the inefficiencies that makes this asset class fantastic, is there's no definitions for anything. There are so many inefficiencies in this niche that it is the Wild West for at least the next few years. There are large institutional players coming in, and I think probably within the next 5 years, you're going to see a definition that's going to shift it from that 1, 2, 3, 4, 5-star thing that started in the 50s from some guy who just decided to go tour mobile home parks back when they were really, really cool places to be. He just created this list, and that's where that's left over from. They're going to shift over to the traditional ABCD model, just like the rest of the commercial asset industry. And you will see that, and there will be a lot more defined understanding of what this asset class looks like. So, Christopher.
All right, let's move on. So I do want to make sure that, so when you think about, the way that this stacks up is this affordability, so you have this great entry point. And again, you have all this demand, then partnering with the residents, right? Creating great tenant relationships, running a good, healthy business, and that low turnover, that creates this consistent cash flow that fills up the parks. Happy residents that are happy to pay, see the value of what you're providing, so that when you do have, again, incremental increases in rent year over year when their leases end, and it's just going to be $10 or $15 on these multiple lots, this helps as owners and operators create this consistent cash flow, right? And part of this is offset because you have these lower operating expenses. All of this adds up to create this consistent cash flow. The key thing to understand is that when you look at how this stacks up against the other asset classes, is that this NOI growth, has been consistent, right? This is City Investment Research in 2020. It has been, and I think there was actually, even through the Great Recession in 2008, you see where other things sort of took that shared dip, mobile home parks kept going up and to the right. And so this validates two parts of our thesis that we're presenting today, which is you have this great supply, you have this demand when operating well and efficiently, and even not, right? This is across all parks. You see the NOI just slowly ticking up and to the right. This then creates a very good cash flow vehicle, and a great opportunity to park some dollars, especially when you're seeing, a lot of headwinds in the economy. So let's talk then about this opportunity, right? I mean, and this is where I think is just important to read back to yourselves. Like when you think about yourself in your portfolio. You want diversification. Right now, what are we seeing in multifamily? Like we're seeing, especially in the major metros where, you know, my group is holding a lot of apartments, as we're trading into new assets, we're selling at great prices, 1031 exchanging, you know, we're getting equity multiples, exits in 3 years, we're getting low cash flow. Well, when you have what we stacked up here, this demand for affordable housing, you have this limited supply and competition and these great renters, this is where then you can get these great returns right now. Even in this market, you can get 10 plus cash on cash return, which is nice for your portfolio, in addition to some solid equity growth over time, right? And you know, I think what Bo and I have mentioned before is if you look at point number 4, it's a fragmented market out there. So this is where for yourselves as investors, are there buying opportunities? Most definitely. Most definitely. You just have to know where to look. You just have to really just get out there, do the homework, scour the market, because there definitely are buying opportunities. And so, Bo, why don't you talk a little bit about mobile home parks during the pandemic? Because I think that's a great question. You know, how did they fare during the pandemic?
Yeah. So, and this is pretty consistent across, you know, all the owners that you know I've talked with as well. We maintained over 90% collections all the way through the pandemic. We didn't have a lot of issues with it. I think that's for a couple of reasons. One is our rates are so much below what you see in other housing options that it's hard not to pay a $200 or $300 monthly bill for your house when, you know, like that's minimal. If you're paying $1,000, $1,200 for an apartment, you know, that gets rough. They can't evict you. But if you own your home and you just have to pay your lot rent, or eventually I can come after it, they just pay. So we never really had any issues with that. We were able to keep that steady all the way through, keep going. The default thing that we talk about, like, if you default on and you own your home, like, you're probably going to lose your home, and for such a minuscule amount of money. So typically we work with people. We're not trying to take everybody's home and that kind of thing. So we'll set up payment plans and we'll work things out with people. And they, you know, generally, you know, worked through the pandemic. A lot of them are in essential jobs. They do cleaning, they do, you know, maintenance, they do stuff that people needed to do. A lot of them have fixed income, so their checks never stopped. So it's a really good benefit of this asset class that, you know, people kept going. We had a lot of people that work from home, teachers, things like that, where they can, you know, as long as they can get online, they can work right from home. Their income doesn't really stop. So the consolidations occurring, like I mentioned before, there's a lot of institutional players starting to get into this space. It's good and bad. Obviously, they're starting at the top and working their way down. So Christopher and I took a different tact, and we were like, let's go a little bit lower on the food chain, get away from those institutional quality assets so I don't have to bid against the big players in the world. And I'm going to buy something that in 2 to 3 years, they're going to want that. And they're going to drive that price up for me while I've been making all these improvements to these 2- and 3-star parks along the way. So that's really a lot of what our mindset is how do you front run that trend as things are consolidating very, very rapidly, and cap rates are going from, you know, just 2 or 3 years ago, you could pick up a park for a 10 cap all day long, and there's stuff trading, you know, almost equivalent to, you know, Class A multifamily right now, like ridiculous cap rates that aren't going to cash flow for the institution for years, and they don't care. So, you know, that's really kind of how we've looked at things over the last few years, and what that's done since the pandemic started.
Yeah, and I do think that, you know, the one thing to note, right, when you're thinking about mobile home parks and you're analyzing it as an investor, is that, you know, there still is an entire world out there, right? There is this world of these, you know, 5-star parks that are being run incredibly efficiently. Outside of that, as Bo stated, there's this Wild West. So we want to tease out for yourselves as investors is when you're thinking about this opportunity is, you know, what are the inefficiencies that you want to look at versus the opportunities? Because this is really where you're going to be able to pick out who is a savvy operator, who is actually trying to target these inefficiencies and turn those into gains for you as investors, right? And so generally speaking, the majority of mom and pop owned you know, shops are not going to be run as a business. You know, when you get down out of these 5-star parks and you walk in and you talk, you're going to find people that manage it on a on a notepad. You're going to find people that manage it outside of an LLC in their own bank account, or you're going to find people that are managing it more efficiently, but you're going to see an entire gambit. So this is where then you want to pivot and say, okay, is the operator that's taking it over, or yourself, are you going to be able to then run it like a clean business with clean books? Because, you know, instantly you can start adding value when you start dividing out home rent and lot rent to the bank. Very simple, but there's a lot of owners that aren't doing that today because they don't care. They're running it as a cash business. And their metric is, how much cash am I getting out of this park every month? And then how much do I want to deposit in the bank? Because a lot of them collect 10, deposit 8, which again is great for the buyers. The other thing is that many of these owners themselves, the mom and pop owners, are baby boomers, and they are tired. And I'm sure, Bo hears the stories all the time of, the owners that are just tired of dealing with the residents, or they're running a park at 40% occupancy because they're getting the cash they need. And they just plainly state, I am tired of dealing with people. Again, great opportunity that then an efficient park operator can come in there and really take over a well-run park at a decent price, fill up the occupancy, and all of a sudden have great cash flow. There's also, again, looking at the fundamentals of the park. The infrastructure is, okay, where, are they self-metering the water? Are they metering it out to the tenants? Or are the owners, sometimes they just pay the water bill because, again, it's easier. They don't have to deal with all the hassle. Then there's a lot of technology now where you can actually self-meter the water. We talked a little bit about the run the cash business. Now, as a mobile home park operator, there's Pay Near Me, which is a great technology, puts a QR code on tenants' phones or in their hand on a piece of paper. They walk into a Walmart, a 7-Eleven, dollar store, a lot of these stores that are within walking distance of the parks. They go, give them their cash, scan the QR code, cash goes into our bank immediately. It's not a cash business anymore. That creates a ton of efficiencies and actually reduces a ton of overhead. And then again, we talked a little bit about the low occupancy. Was there anything that's not on the list that you wanted to highlight, Bo?
No, I think, yeah, just as you're going in and looking at these things, once you start to know what to look for, like we look for heavy park owned homes with a lot of vacancy. Those other more institutional players, they hate them. They don't look for that. They want all that done. So we look for that. I look for any mobile home park that is held in an owner's personal name. And once Christopher mentioned it, once I find out they've also been, muddling it together in their own personal finances, that opens up opportunities to discuss seller carry. It gets them out of hot water, because one of the reasons they've held on to this thing as long as they have is they don't want anybody digging around and figuring out where all the money's been going over the last few years that may not all be, claimed where it should be. That's fine. Give us 2 or 3 years of seller carry at favorable terms. We'll clean that up. What is that? Sorry. But yeah, we'll clean those books up. We'll be professional operators. We'll claim everything, clean the books up, and all of a sudden everything's on the up and up again. Banks are happy, IRS is happy, they're happy, and sitting on the beach, all that happens. So that is one of the things, as you start to look at these and you start cold calling and reaching out and figuring out if you want to be into a park, those are some of the inefficiencies that would be red flags in other industries that are, green lights for us, and we seek those opportunities out. So.
Very much so. I do see B. Dwick asked, what are exit strategies? We'll get into how to invest in a moment, but I think the exit strategies are going to align with, your operators, right? Do you want to position this to resell to institutions? That is an easy play, especially if you're adding a lot of efficiencies, or do you want a long-term buy and hold? And I think it depends on, again, we'll talk a little bit about the investment strategies, but you have with these parks, either are an option, or you can also, there's some people that do the land value. They want to get it, run it as a mobile home park for a number of years. And then the land value where they hold it is developing around them either commercially or residentially, and then they want to turn it into something else. So there's a lot of options when you get into mobile home parks, a lot of different strategies.
Hey guys, there's a couple other questions here that I think we passed up from Matt.
Sure.
Do you have any experience with parks that have sewage lagoons? What are your experiences? And then also, I believe you said most of your homes are mobile homes. Does that mean they were built before 1976? And then another follow-up by be weak. So if you can address those, that'd be great.
Yeah, so I'll jump on. Yeah, so the depreciation, I have to dig back through my cost seg. It's a lot of stuff. I think we have very little that actually depreciates at 27 and a half years. Everything, the majority of it, probably 80% of the stuff that we depreciate is 15 or below. We've got a pretty significant 5-year depreciation as well. Lagoons, we avoid them. And it's not because they're horrible. Some people, I know some guys that make an absolute ton of money buying them because people like me don't want them. If you have a really good understanding of how they work and you are very, very comfortable talking with municipalities and state regulators for environmental concerns, and you can really dig into the due diligence and the compliance that goes along with having a giant pond in your property that is full of waste, you can make an absolute killing. You can buy 20 caps if you want to. Like, people are almost giving those things away. If you do not have that expertise, avoid them like the plague, or they will clean your clock. We do have a lot of homes that were built before 1976. So we buy these parks that are aged, eventually we can life cycle those out. Right now, we've got people that want them, because if I sell you that house for $1,000 and charge you a $400 lot rent, you're still at $500. You can replace all your own wiring. You can do your own work. You can renovate that home, and it's not a huge issue. And it's still the absolute cheapest thing you can do as far as housing in this area. Exit strategies, as Christopher mentioned, we'll talk about in a bit. Typical leverage, land versus owned units. Typically, I mean, we see a lot of 30% down just because it's easy. The sellers that are, not very professional, they're fine with that. It's typical what they are used to hearing. So we do 30% down, 30-year notes. A lot of it's interest only for 3 to 5 years, and they sell or carry it for. So for fairly favorable terms. Lenders, obviously the bigger you go, the better the terms are, but it's easy to see 65 to 75% LTVs, depending on the quality of the park. Would you invest in parks with private water, sewer? Yes. So not a huge thing. Getting your water checked and tested by a local lab is easy. Just make sure it's clean, safe. You put them on a monthly plan. It's $100 a month. They just come out, take a sample, and send you a clean bill of health every month. We've got a lot of septic tanks, both individual behind homes, as well as like some larger commercial tanks that'll handle 5 to 6 homes in that one tank. Makes it easy to service, makes it easy for people to not drive on it. And yeah, so yes, there are brokers who specialize in selling mobile home parks. It's going to be tough to gain their trust and get them to sell to you if you've never bought one before, just because everybody's blowing them up trying to get into this asset class, and they have a lot of tire kickers. So be happy to introduce you to some and get you on that path, but it is a tough racket to go with them. Self-managed. So that's another one of those inefficiencies that should be on this slide. Is there is no property management for mobile home parks. Yeah, so I am the property management. My wife and I built out this company. We have employees that work for us that all we do is mobile home parks. We only manage ours. We don't manage anybody else's, just because there are so many different ways to run these things for different strategies that every management will be unique, which is why a lot of property management companies will avoid them. Which is why a lot of these really tired owners are still self-managing, because nobody will manage their properties for them. So if you're going to get into this industry, you need to partner with somebody or be very comfortable running your own management company, managing employees, and then building out those systems yourself.
Well, and let's actually get into, I think then, we'll close this out, and thank you so much. I think these questions are great, the back and forth, but, essentially there's really 2 ways that you can participate in this asset class. There is buy and operate, or there's invest passively. And so, we can talk about this a little bit, but when you want to get started in mobile home parks, you can look at individual ownership, just like some of these people that built these from the ground up, where they're essentially, purchasing these parks, running them themselves as an asset, whether that's something they live close to or far away, or you can, joint venture, with somebody else. Now, this is something that I went down this path. I was actually looking at purchasing my own mobile home park, my wife and I, and then that's actually how I met Bo, because I knew Bo, we'd met through a networking group, and I knew that he operated mobile home parks, and I called him And interestingly enough, I actually sent a note to a buddy who I knew was a passive investor who had, personal holdings and was also in syndications as well. And I sent him an email, said, hey, how's that mobile home park going? I knew he lived in California and purchased something in Memphis. And he sent me an email back that read like a bad movie script about, people coming in, inviting people in, burning down units, blaming him for it. It's definitely like not for the faint of heart. And I'll let Bo add a few things in,
Yeah, it can be the Wild West. So not a passive thing where you're going to get, you hear a lot of podcasts that talk about it being mailbox money. It is for the investor. It is not for me. For me, it is a very active thing, and it's a job, and I love it. And I didn't think I would love it as much as I do after 20 years in the Army, but it's Sisyphus, I'm pushing my rock, man. So I like it. But yeah, he talked, hey, I live in Texas. I want to buy a park in Tennessee. And I didn't tell him no. I just started asking all the questions about, kind of leading you down this path of how are you going to deal with this? Because if you let this asset class go, it will get away from you quick. So definitely individual ownership, and I'm happy to help. And I would be,
what am I doing with this?
Bring out to me and I'll talk to you and help you and consult with you about strategies and ways to get into this. Happy to do it. I love the asset class. I like being out here. I'm in a park right now. Love it. So and there's also obviously the syndication fund stuff, and we do that as well for people who want to be in the asset class but don't want to be me. Really happy to work with you on that as well. I see one more question for the star rated parks from Miss Mary. We look at 2 and 3 star parks. I think we've got a 4-star park coming into our portfolio next month, but we don't really pursue them. We look at the lower rated parks, things that have obvious issues, things that, with some massaging and operational efficiencies, we can take from a 2 to a 3+ or, a 4- quality. But that's really where the value add play comes in. And for that, we can buy these things at, 30 to 50% of market value because nobody else really wants them. But we've got the infrastructure in place. We've got the experience. We've got the network around Fayetteville in this area specifically to work with law enforcement, to stay on top of stuff, to deal with local municipal issues that come up with the eviction courts and liens and things like that. We can work through those processes. Yes, senior parks, extremely great quality. You find a ton of them, especially down in Florida. We don't have any here. It's just not something we've gotten into, but they are definitely a higher quality. But I think that would almost be more of like a retirement village most of the time than necessarily affordable housing. So same asset class, but not really the same strategy going in. And again, here in North Carolina, we don't have any rent control yet. We're trying to keep that out as much as possible. And just be responsible owners and take care of people to where we don't have to have the government come in and mandate good behavior.
Yeah, so I just wanted to close off. So I think, the 2 ways here, as we talked about, is individual ownership. So where you're crunching the numbers, you put together your operating plan, you get that underperforming park, and then you execute the plan. And again, setting the expectation that in this asset class, you will have to manage your own. You can't go find some other manager. You are going to be hands-on, and then alternatively, right, is there's syndication fund or joint venture, right? And this is, I think, where a lot of us, come into these types of groups to really understand what are the types of offerings that you can. And I think the benefits of this, right, where you're hands-off, lowers the risk, and honestly, better returns because less of your time, more cash delivered. And so, we'll just touch on the fact that, we are, syndicators, fund managers. We are going to be launching next week the Evergreen Income One. It's our new offering through the Thrive Community Fund. If you want to sign up to be notified, there's the link. And we're here to answer any more questions that you may have. We'll spend the last time answering questions and seeing how we can help.
See, Mary submitted one more as well. value add renovations considered common areas, clubhouse. It's actually a lot simpler than that. You can add those things. Our value add strategies go back to cleaning things up, really turning the tenant base over, dealing with safety issues first and foremost, adding street lights to brighten the area up. We paint or vinyl side all the homes that are in place. We cut back trees that are dropping stuff through people's roofs, things that seem really like they would have been done, but they just don't. Again, the tired owners leave a lot of these things back. So for us, you can come in, not raise anybody's rents, take care of a lot of these issues. And we gauge everything off of our value add strategy is kind of what we call the school bus test, where if your kid's getting off the bus in front of this place, is he going to get picked on? No, not at our place. You're not. Everything looks nice. Everything's clean. There's no craziness going on. There's no trees falling over houses, no burned out houses. This place looks nice. So it went from a 2-star to maybe nicer than they ever thought it would be. They are happy to jump in with us and join us as partners long-term and be good residents with us. So that's really the value add strategy is that simple. You start with that hierarchy of needs of, is it safe? Can I be proud of it? Can I drive through here and drive, people to visit me and they're not going to be like, ugh. Little things like that mean so much in these communities that you'd think it'd be, more complicated, but it's really not.
Can you guys put your contact information in the chat? There was a request to schedule a call with Bo, but maybe if you can put your email or however you'd like people to contact you in the chat, that would be helpful. And then we also have a question about, is this the fund, is it deal specific or is it an actual fund of assets?
Well, it's going to be a fund of assets. The way that we run our funds is we identify the assets and then we actually acquire funding for that asset. So people get an opportunity to choose, and you'll find that, this will be our second fund. And our focus is really on making sure that we're able to hit the return profile. Our focus right now is to be different in this current environment. We want to focus on high cash flow, long-term hold. We are not going to be low cash flow, giving you capital every 3 years. We want to be the alternative to that.
Okay. And well, one more question, debt or equity? And then I have a question after that.
It's going to be equity.
Okay. So when we look at multifamily, everyone's from passive investors, right? We find the sponsors and we figure out, we want to invest with them. They send us a deal. I don't want to re-underwrite it from scratch. We have some tools that we use. We have a deal analyzer in our infield group. And so I always ask, like, for an asset class like this, it's a little bit different. It's not going to work the same. The metrics aren't the same. Can you give us 2 or 3 metrics that we should be looking at if we're going to analyze a deal from a passive investor perspective, and we don't want to go and re-underwrite it? That's your job. We're going to get to know you and decide if we want to invest with you. Yeah. But then we want to know, like, give me 2 or 3 metrics that I can look at to kind of say, okay, this deal kind of checks out.
Okay, I'll start with that, and then Bo, please add color, as I know you will. So number one is the important thing here is it's all about the lot rent. So this is the key thing we try to tease out in the beginning is that lot rent and home rent have to be broken out, because lot rent is going to be capitalized. That's what's going to go towards the value of the property, and that's what's going to truly go to the NOI. Home rent, they don't count towards NOI. It's great because it's additional cash flow, but that's not NOI. So then it's really, what is the lot rent? And then, what are they seeing in the market? Where do they think they can take it? And so that's, I think, is one of the key things. Always looking at, things like, your standard issues. Some of them still apply, like your DSCR still applies. And again, expenses, you're going to want to see expenses should be somebody who's doing some conservative underwriting, as Bo said, is going to be 35 to 37%. Even though you can take it lower, you want to really try and target it there. I think that's going to be really conservative. And I think one of the things that you always want to look at is you're going to find what is the cost per lot you're paying per the lot rent. So if the lot rent is $350 and they're paying, $40,000 per lot, you can sort of do the quick sort of 1% math and you realize, okay, you're a little upside down on that versus, you know, for example, in our last fund, we purchased at an average of $27,000 per lot. We underwrote to 350. We're actually getting 463 in the market. You can see that that gap is then going to provide tremendous amount of cash flow. Those are key metrics that I use. What are some of the ones that you use, Bo?
Yeah, so I'll say the big one is the expense ratio line. So you can either see really, really high expense ratios where they're 60%, 70%, and then you can start you need to go in, and if you're working with a broker who's not experienced in this asset class of starting to pull things out, you'll find, you know, the owner's truck that's going with him. You'll find life insurance for employees. You'll find, you know, crazy cell phone bills and other bills and things like that. Or the more, you know, dangerously is you find them extremely low. Hey, I've got a 12% expense ratio on this. Okay, I'm going to need to see some bills. Where are you going with that? And they, you know, a lot of things get left out. So, and that doesn't only come with owners that you're talking with. That's experienced brokers. You know, first point, once you start getting those offers back, what's the NOI? Teasing out that home rent, lot rent, and if you're buying a lot of park-owned homes, they don't break those out, and you will pay for capitalized income that lenders aren't going to see. So those are huge ones. And then I think you would start to look for those inefficiencies in that metric. You can look at, hey, is the park owner paying utilities? Is this thing master metered? That can be as much as, you know, 10-15% of your expense ratio. So if you're up around 45%, 40-45, is it because we're paying for utilities? Can I bill those back? And I pay for Metron submeters, I'm passing that through, and I've just knocked 10% off of my expense ratio. So I think those are some big things you can definitely go in and look for and figure out real quick, is this going to be viable or is it not?
Yeah, and I think the other thing too, like I want to take it actually up a level and say, like, what are things that we would say, don't ever do that. So if you go in and somebody is saying, I'm going to buy a park of tenant-owned homes and I'm going to adjust the lot rent by $150, $200, depending on the municipality and the state you're in, that could be a train wreck. So it is important to understand, like, the percent, like, we go in and look for a lot of park-owned homes, because then we know that then we can start, you know, implementing our business plan and control our own destiny. If you go in and there's a lot of tenant-owned homes and you think, okay, now we're going to go in and start, you know, getting to market lot rent, because a lot of owners, they don't take it to market because they're getting the cash they need. So they don't want to fuss with people. So this is where tenant versus park-owned homes, that metric, if you go in and say it's a 80% tenant-owned home park and we're going to do X, Y, or Z, I'd take a step back.
It'll give you pause.
Yep. And then I think the sewage, what was that? I know we talked about it before, but we don't look at those, the sewage.
Lagoons and wastewater treatment plants, a lot of opportunity there. If your wastewater treatment plant fails, it's about $500,000 is the cheapest one I've ever seen. So if you're buying a small park, it's got a wastewater treatment plant, you've really, really got to dig into the engineering of that. The lagoons, those can be multiple millions of dollars, which if you're, you know, a 400 unit apartment complex, like, that's not a huge deal. Like, we'll pay $2-3 million to clean this, you know, future super fund site up. And then if you're a $5 million mobile home park, that is devastating. Like, you cannot absorb that. So again, for us, the risk is just not worth it. There are enough clean parks still out there where they're on either normal septic tanks, which everybody's comfortable with, or municipal sewage, and you can just, you know, look at them, deal with it, replace some piping, and move quickly, and incur a lot less risk. So,
yeah. And so John Wright asked, what's the exit strategy and timeline for LPs? You'll find that we're 10+ year hold, but we look for middle of the term. We look for opportunities for cash out refi to be able to give invested capital back. But we want to be different in your portfolio. We are not the multifamily players. If you want cash, you want to exit every 3 years and get the cash back and have lower cash flow, there's people for that. What we want to be is, we want to be 10% and above cash on cash return. We want a long-term hold, and then we want to look for an opportunity to then start harvesting equity along the way to give it back. But we want to hold it for 10 years plus, because again, this is my perspective as a passive investor. I don't have enough real passive income, double digit or plus, in my portfolio today. That's the need that we want to fill.
Excellent. I don't think we have any more questions. So closing remarks?
Closing remarks. I mean, I'd say, number one, thank you so much. We are huge advocates for things like the left field investors. We think that, getting together with investors, asking great questions, super important. So thank you so much for having us. This has been a real treat, number one. And then number two is, we do believe in this asset class, and we do believe that, passive investors should be looking to have this in their asset class, because as we're looking for headwinds in the market, we don't think that anything is going to perform better, in the next, 3 to 5 years. We're very, very bullish on this asset class. And, if you're interested in getting some high cash flow, long-term hold, call us.
Awesome. And then the last thing, can you put on that last slide, you had a way to sign up for your newsletter or the deal coming out. Can you put that in the chat, and I will include that and your email addresses in the recording when I send that out today or tomorrow.
Of course. I'm going to actually get you the URL. So this is a way that people can get some information about us. Yeah. And sign up, and you'll hear all about us, see what we've done. And then you'll be on the list of what we're going to do.
Perfect. Well, thank you, Christopher. Thank you, Bo. We really appreciate you coming out and having a virtual lunch with us. The presentation was fantastic. We really enjoyed it, and we had a great showing. So it looks like noon on a Friday is a good day for a lunch and learn. So thank you very much, and we'll definitely be in touch with you guys soon.
Thank you so much. Appreciate you.
Excellent. Thank you. Appreciate it.
Take care, everybody. Have a good weekend.